Good day to everyone. My name is Humphrey A. Ojige and I'll be reporting about the National Internal Revenue Code of 1997. Here is the topic outline for our report. We will be discussing about the relevant provisions of the National Internal Revenue Code with regard to business point of view. The first in our list, we will start from amendments to NIRC up to the period of prescription or the limitation on assessment of the NIRC. Now there are two significant amendments or tax reforms to our National Internal Revenue Code or Tax Code. These are Republic Act number 8424 and 10963. As you can see, these laws have the following long titles and effectivity dates with regard to the two laws. For purposes of convenience, RA 8424 will be known as the National Internal Revenue Code of 1997, while RA 10963 will be cited as Tax Reform for Acceleration and Inclusion, or TRAIN. In the Tax Code, Section 21 states the following sources of revenue, which are considered as national internal revenue taxes. Keep in mind, these are different from the local taxes imposed from the local government units. As listed, these are the following: income tax, estate and donors taxes, which are also referred as transfer taxes, since they signify transfer of ownership from one property from one person rather to another. Value-added tax, a form of business tax. Other percentage taxes, which is also another form of business tax. Excise tax, which is a tax on the production or sale of certain commodities. Documentary stamp taxes, and such other taxes that may be imposed or collected by the Bureau of Internal Revenue. Now I have summarized here important provisions of the tax code, so we will be focusing more on these sections with regard to the business point of view. The registration requirements is stated in section 236, while the maintenance of books of accounts are stated in section 232 to 235. Section 237 and 238, on the other hand, relates to issuance of official receipts and invoices, while Section 241 pertains to display on certain certificates in the place of business. We now see here the overall view of the taxation process. Now, registration, filing, and payment is heavily reliant on the taxpayer's side, known for short as RFP. Audit or enforcement, on the other hand, is for the Bureau of Internal Revenue, which they tasked to monitor if the taxpayer is doing their RFP, register, file, and pay. So you only need to register once with the Bureau of Internal Revenue. If you are an employee, you must register within 10 days from the date of employment. If you are a business owner or practicing profession, you must register on or before the commencement of business, or before payment of any tax due, or upon filing of a return, statement, or declaration as required in this code. So for those registering their business or practice of profession with the Bureau of Internal Revenue will issue a certificate of registration. The certificate of registration, or BIR Form 2303, is a proof or confirmation that you are registered with the BIR. Here you will see your tax identification number, your registration date, the registered address, your trade name, the line of business, and you can also see here your registered tax types that you will need to file and or pay with the Bureau of Internal Revenue. Please keep in mind that the certificate of registration must be displayed in the registered place of business and must be easily seen by the general public or customers. It is also applicable for notice to issue receipt and the payment of registration fee amounting to 500 pesos, or it must be easily or conspicuously placed in the registered place of business. All persons engaged in trade or business or in the practice of profession duly registered with the BIR are required to maintain books of accounts, where all the relevant transactions or result of operations of your business are kept or recorded, examples of which are general ledger, general journal, and sales and purchases journal, among others. Taxpayers may maintain its books of accounts in any of the following manner: manual books of accounts, loose-leaf books of accounts, and computerized books of accounts. Now, to use the loose-leaf books of accounts or computerized books of accounts, one must have permit to use issued by the BIR. When it comes to bookkeeping requirements, books of accounts must be kept in the registered place of business. Keeping of two or more sets of books of accounts is prohibited. Entries in manual books of accounts shall be handwritten. Take note, manual. And printouts of the actual records pasted or glued, inserted onto the pages or sheets of the registered manual books of accounts are highly prohibited. Again, it must be handwritten. For the manual books of accounts, it shall be registered before the deadline for filing of the first quarterly income tax return or the annual ITR, whichever comes first. The loose-leaf books of accounts is a recording of transactions through encoding of details in the computer and generating copies by printing this out using the approved loose-leaf format, mainly from Microsoft Excel, to be bound as the bookkeeping record of the taxpayer. Now, the deadline for the presentation of the loose-leaf books of accounts to the Revenue District Office will be 15 days at the end of each taxable year. The computerized books of accounts, on the other hand, are those reports which are generated from a specific computerized accounting system, software, or program. The deadline for presentation of computerized books of accounts in electronic format will be within 30 days from the end of each taxable year. Now, if your gross annual sales or receipts is over 3 million pesos, your books of accounts must be audited and examined yearly by an independent CPA. Now, for the subsequent registration of the manual books of accounts, normally before the pages of the existing manual books of accounts will be fully consumed or used, you must have already registered a new set of manual books of accounts with the BIR. Now here we have certain examples of books of accounts. It is the cash receipt journal and cash disbursement journal, among others. The cash receipt journal records all the cash you have received in conducting your business, while the cash disbursement journal records all the cash you have paid in conducting your business. With regard to your business, we have principal receipts or invoices that are proof or evidence of sale of goods or services that are issued to the customers, and these are the following. It is divided into sale of goods or properties and sale of service and or leasing properties. For sale of goods or properties, it is VAT sales invoice and non-VAT sales invoice, while sale of service and or leasing properties relate to VAT official receipts and non-VAT official receipts. Now, for purposes of definition, VAT is considered as value-added tax. Now, VAT sales invoice is for VAT-registered taxpayers, signifying sale of goods or properties which are issued to the customers, whether it is cash sales or sales on account. This is the basis of the output tax liability by the seller and the input tax that will be claimed by the buyer. While VAT official receipt, on the other hand, signifies sale of services or leasing of properties. For those non-VAT registered taxpayers, the sales invoice and official receipt will be the basis for the percentage tax liability of the seller. Now, these are all written admission or acknowledgement that the money paid by the buyer has been received by the seller. We also have some supplementary receipts or invoices. These also signifies that there is an existing transaction between the buyer and seller, and these are already reported in the books of accounts for recording, monitoring, and control purposes, some of which are delivery receipts, acknowledgement receipts, and any other documents that may be of use to your business. Just a reminder, all supplementary receipts or invoices for purposes of value-added tax or VAT are not valid proof for claim of input tax by the buyer. Now, all taxpayers engaged in business must secure authority to print for the principal and supplementary receipts or invoices used or mentioned in the previous slides. Now, each head office and branches for each business establishment must have its own official receipts and or invoices. Keep in mind that for taxpayers with expiring authority to print or ATP in their primary invoices or receipts, they must apply for a new ATP 60 days before the actual expiry date. They must surrender all unused or unissued principal or supplementary receipts or invoices to the Revenue District Office. Now, receipts or invoice must have the taxpayer's registered name or business name, the registered business address, whether it is VAT or non-VAT, and the tax identification number, the date of transaction, and the space provided for the name, address, and TIN of the buyer. The VAT amount if transaction is subject to 12% VAT, and those sales exclusive of VAT, and the discount for senior citizen or persons with disability. For non-VAT official receipt and sales invoices and other aforementioned supplementary receipts or invoices, the phrase, "This document is not valid for claim of input tax," must be printed in the receipt. Now here is a business registration reminder. The BAR conducts a tax compliance verification drive or tax mapping operations to monitor if the taxpayer is complying with the registration requirements, as mentioned in the previous slides. For business, an annual registration fee of 500 pesos shall be paid on or before the last day of January every year after the initial registration. The payment form, as explained before, must be displayed conspicuously in the place of business. Now we move on to the next part of our report. It is the discussion on some tax compliance. In the new train law, the income tax has already excluded or removed the personal and additional exemption provided in RA 8424. This because in the new train law, the personal and additional exemptions are already included in the 250,000 threshold as exempt from paying income tax. There is a tax imposed on your income based on the following rates. So for individuals, it will be based on the graduated tax table as presented. For corporations and partnerships, they will be taxed at 30% of the taxable income, while purely self-employed or practice professionals or mixed income earners whose sales are not more than 3 million has the option to be taxed at the 8% flat tax rate or the graduated tax table. Your income tax is required to be submitted quarterly and annual. These are the following filing dates and/or payment dates for income tax. Taxpayers may choose from the two allowable deductions. The first is itemized deduction, where you deduct the ordinary and necessary expenses relating to your business. Take note this must be directly attributable to your business and must be duly substantiated with receipts and invoices. It must also come with financial statements. Examples of expenses are salaries and wages, rental, etc. Now, if sales is greater than 3 million, as mentioned before, it must be audited by an independent CPA. Your financial statements. Now, for the optional standard deduction, it will only be a 40% uh, basis on the gross sales or receipts. So, for the optional standard deduction or OSD, it is 40% of sales. Now, percentage tax is one of the business tax imposed on persons or entities, particularly those in Section 116 on persons exempt from value-added tax. Now, percentage tax is applicable for those having gross sales or receipts, which is 3 million pesos and below for a 12-month period. The tax rate is 3%, and here is an example on how to compute the tax due. Now, this is the deadline, the filing requirements, and payment for percentage tax. Now, percentage tax is not exclusively limited to the rate of 3%. Here we have other percentage taxes which have different rates applicable to certain types of business. Now, if you are a taxpayer who was initially registered as a non-VAT taxpayer or those filing for percentage or paying for percentage tax, if you happen to have in a 12-month period your income exceeding the 3 million pesos threshold, then you will be required to immediately update your registration from non-VAT to a VAT taxpayer. Now, value-added tax is another form of business tax, and it is usually a tax of consumption levied on the sale, barter, or exchange of goods or services in the Philippines. Now, here is an example on how to compute your value-added tax payable. So it is just a simple case of deducting input tax from your output tax. So output tax of 420,000 minus the input tax of 240,000, then you will get your net VAT payable of 180,000. When you need to file or pay for your value-added tax, here are the BIR forms to be used and the mandatory payment deadlines. Next, we move on to withholding tax expanded. So it is a tool in collection of taxes, and we have many classification of withholding taxes, one of which is the creditable withholding tax. Under the creditable withholding tax is the withholding tax expanded. For example, if you are paying a monthly rent in your place of business, then you are required to withhold a tax rate of 5% based on your rent payments. In this case, if your rental fee is 10,000 pesos, the amount you will withhold is 500 pesos, which you will remit with the BIR, meaning the remaining amount to be paid to your lessor is only 9,500 pesos. And here are the mandatory payment and filing deadlines for your withholding tax. For more information on withholding tax expanded and other types of withholding tax, you may visit the BIR website. If you are an employer in your business, then you are required to file and/or pay withholding tax on compensation in behalf of your employees with the following stated deadline. At the end of the taxable year, there are certain annual reports which you are required to file or submit, some of which are the following BIR forms. Now, based on the tax code, the BIR has the authority to check or audit or assess if you are really paying the right amount of taxes within the period of 3 years. The exception to the 3-year prescriptive period are the following. In the case of a false or fraudulent return with the intent to evade tax or failure to file a return, the tax may be assessed at any time within 10 years after the discovery of the falsity, fraud, or omission. So take note of that. So here is one last reminder before I end the report. The BIR's integrated tax system detects non-filing or non-payment of tax returns by a taxpayer. And that is the end of my presentation. Thank you so much for listening. For more information, you may visit the BIR website.